The broadcast is now starting. All attendees are in listen-only mode.
Welcome and good afternoon, everyone, on our webinar, Achtung Related Trust, Tread Carefully. I can see people are still joining, so we'll just wait for a couple of seconds. All people can join, and then we'll continue with the presentation. Thank you. Once again, welcome and good afternoon, everyone. Welcome to our webinar on Achtung Related Trust, Tread Carefully. So before I continue, can someone from the audience please confirm if I'm audible? You can just type yes in the question section and we'll get moved forward with the presentation. Can someone from the audience please confirm if I'm audible? You can do so by typing yes. All right, Anthony, perfect. Thank you so much. Once again, welcome everyone. I'm Akif and I'll be your host for today's session. Thank you for joining us as we dive into the new sense of managing related trust within self-managed superfund. So before I continue, I'd like to go through some housekeeping rules. The presentation for the handouts for this presentation have already been attached. You can download them from your panel on the right hand side. In any case, if you are unable to hear the audio of this webinar, you can always dial the number shown on the screen, put in the access code and the audio pin, and you can always join through your mobile phone. If you have any question regarding the presentation, please do not hesitate to ask. Manoj will answer all of the questions at the end of the webinar, and I will really appreciate you people asking questions. So that's going to make our webinar more interactive for all of us. Now, I'd like to give you a brief introduction about Manoj Abhichandani. Manoj has worked in SMSF space since 1988 and seen changes in SMSF space from the earlier days to a $1 trillion retirement pool. Initially, he worked as an accountant for 7 years for two CA firms in Sydney in the SMSF division, and then is in his own CPA firm for 19 years as an advisor to 600 SMSFs on strategic issues. Today, he works as a product manager for trustdeed.com.au, where they support more than 10% of all SMSFs in Australia. Now, I'd like to welcome Manoj Abhichandani. Welcome, Manoj. How are you going?
Good. Thank you, Akif. Yeah, I today have a very interesting topic. And if you remember, we have postponed talking about this topic a couple of times. So I apologize I think I was not well and then I had to be away for a reason. So today is the time we're going to talk on this very interesting topic of related trusts. Now, my presentation is not only for trustees, but also for auditors, because when a super fund invests in a related trust, we as auditors need to make comment about it in the audit report of the fund and pass judgment whether there are no in-house assets of the self-managed super fund. Now, before I proceed, I'm just going to make sure that you do understand. I will be talking about investments by a fund. So just want to make sure that anything, whatever I say today, should not be taken as financial advice or not something what you should be doing yourself um, or you should be not recommending them to the super fund trustees if you're not an advisor, if you don't hold a financial services license. So just be careful on how you advise trustees. Now, just an overview. We know that Section 71 is one of the compliance sections in the audit report, and it is your responsibility to report on any breaches of Section 71. Section 71 is mostly talking about in-house assets of the super fund. Today, we're going to discuss what is an in-house asset and how does an asset becomes an in-house asset over a period of time, even if you don't do anything in the fund, like if no changes are from 1 year to another year. Now, there are certain assets which can be exempted from the in-house asset provision. We're talking about 1322C trust, and I'm going to touch on that as well later in my presentation. But how trustees can unknowingly breach this rule, and I'm going to suggest some of the remedial actions one can take to avoid paying penalties um, if we by mistake breach in-house assets. Now, in-house asset is basically a loan to a related party, or it's a loan or an investment in a related trust. And if you lease an asset of the fund to a related party, all these items are considered as an in-house asset. There is a minor exemption for 5%. That is, if you have assets which have like a loan to a related party or an investment in a related trust or a lease to a related trust, if the total assets of the super fund, if not more than 5% are loan to related parties or related trust or related or a lease to a related party, then that exemption will apply. Now, there are some specific exclusions, and I'm going to talk about those specific exclusions. But you must remember that in hindsight, loans are allowed, but they are subject to 5% limit. Now, 5% of the market value of total assets of the fund cannot be uh, loaned to a related party. Now, I must say one thing. We must also consider Section 65 of the SIS Act, which says loan to members and loan to relatives of members. They are 100% prohibited. That means even 5% of the assets of the fund cannot be loaned or leased or invested to members. So this is something you must distinguish between members and relatives and related parties. And today we are going to talk about the differences between the two. Now, it's very important to know who is a related party. There could be many reasons why you want to know that. And the first is Section 66, because when we buy any asset, we have to make sure that we haven't purchased it from a related party, although there are a couple of exemptions, let's say listed shares or business real property. Now, if you have, if the super fund has some cash sitting in it and it wants to buy an asset which you as members or your company or your trusts own, which are none of these, like residential properties, or let's say there's a painting or artwork or any other asset, even diamond, for example, they cannot be the super fund and cannot acquire them from any of these related parties. And the second is for Section 71 purposes, that is, we need to make sure that if we are lending or leasing or lending or uh, handing an asset to a related party, the value of that asset is not more than 5% of the fund's asset. So what we are talking about is a unit trust, and maybe that unit trust has borrowed money, and there could be other investments into that unit trust by other related parties, and that related party has borrowed. If that related party has not borrowed, or the unit trust has not borrowed, then we will talk about it later in my presentation, because then it becomes ungeared unit trust. An ungeared unit trust come under section SIS regulation 13.22C, and we're going to talk about those a bit later in my presentation. Now, as far as a related party is concerned, they could be, they're defined in section 10. They could be other members of the fund or Part 8 associates or standard employer sponsor. Now, Part 8 associates is a difficult term to understand, because a person can be a Part 8 associates today and may not be a Part 8 associates tomorrow, depending on your relationship with that person. And we're going to talk about those relationships with another person, on how one can become a Part 8 associates and stop being a Part 8 associate of a self-managed super fund. But basically, all members are related party of the fund. A standard employer becomes the related party of the fund. And then there could be certain individuals or certain companies or certain partnerships, other partners in a partnership can also become related parties for that self-managed super fund. Now, basically, for an individual, all relatives of the individual could could be Part 8 associates. As far as relatives is concerned, it's very well defined. Can be a parent or a grandparent, brother, sister, uncle, aunts, nephew, nieces. I'm going to adopted children are all included, and any of their spouses are also included. But just to make note that ex-spouse, if you have divorced anyone, that person is not a relative of that member. Now, other members of the super fund, so they could be like if it's a single member fund, there could be another trustee of the fund. That person can also be Part 8 associates, a partner of any of the members. So a partner means that if you are in a business relationship with another person, that person can be a partner. That partner relationship could be for income or could be for expenses or for both. So let's say I have a friend, and together we own a property, an investment property together, which is outside the self-managed super fund. So that would mean that my friend is a Part 8 associates of my self-managed super fund. Now, if we sell that, like when I mentioned earlier, that a person can be a Part 8 associates and he can stop becoming a Part 8 associate. So let's say we sell that property, which is outside of the super fund, and he's just a friend of mine, he's not my relative, then we stop becoming a Part 8 associates of my self-managed super fund. So basically, if there is a trust, and if someone, a unit trust, and there is a trustee, if someone controls that trust, that person can become a Part 8 associate of my super fund. Now, if I'm investing, if my super fund is investing in that trust, I have to see who controls that trust. So who are the trustees of the trust? Are they relatives of mine? Are they partners of mine? Or they are directors of where I am doing a business? And there are other directors of that business, there are other partners, so there is a partnership, but it is in a form of a company. And that means that other shareholders could also become Part 8 associates of my self-managed super fund. So let's have a look what I'm talking about here. So we have an investment by the super fund in a unit trust, and the unit trust has borrowed money, and this is the super fund under audit. And there is a related party which has also invested in the unit trust, and there's another related party. And this related party is either my relative, or this related party is a partner outside, or this related party, or is, let's say, another associate, friend of mine, where we are running a business together in a company and he's a director in that company. So together we control the unit trust. So if together we control the unit trust, that means that this unit trust becomes a related trust of the self-managed super fund. And if it is a related unit trust, and if it has borrowed money, then my investment cannot be more than 5% of the market value of the super fund assets. So that's what we are talking about here. So this control can be established in many ways, and we are going to talk about how we are able to control that asset. So we understand that that there could be, even just going back, this could be a related party, could be a trust also, and that trust also has investment, a discretionary trust or a unit trust has investment in that trust. So in many ways we can control that trust, and once we control that trust becomes a related party for the self-managed super fund. So to understand this better, let's just look at what is a non-control trust. So let's have a look at, let's look at this situation. This is the super fund under audit, and this is a totally unrelated party. So it could be a super fund, or it could be a company or a trust, whosoever, and this could also be a partner or a person, an individual, a human, any other entity, and they have also invested in the unit trust, and of course there is a trustee of the trust, and not one party has 50% of the units in this trust. So we don't control the trustee of that trust, and none of the trustees of the super funds are related parties, so we are not related in any way. That means none of the members of the unrelated trust is any personal relative of any of the members of the trust or directors of the trustee companies of the super fund. Now, as long as no one single party can control the unit trust, you are fine, because the control is dissipated. Basically, it's a syndicate where the super fund has invested, and there is no limit on how much the self-managed super fund, which is under audit, can invest in this unit trust, and this unit trust can borrow as well. And many a times, if you're an auditor, you would have seen that a super fund has invested in a trust, and the other holder of the units is another super fund, which is basically a friend of the main trustee of the fund which you're auditing, and two super funds have basically invested in a unit trust, and that unit trust has borrowed money. Now you have to make sure that the unit holding is absolutely in the middle, 50%. No one person has higher holding. And as far as the trustee is concerned, they both are trustees. Now here you have to be a little bit careful, because if you have a corporate trustee, some of the constitutions of the corporate trustee may give a managing vote to the managing director. So you have to make sure that you have to remove that managing vote in the trustee company so that there is no clear control of this unit trust by any one of these parties. Now, if you basically control the trust, it becomes a related trust. If you don't control the trust, then it's an unrelated trust. Now, if there is a relationship between unit holders, like I've been talking about it earlier, and I'm going very slow with this, and you may sound that I'm going, I'm repeating, but I just wanted to make it very, very clear, because when we audit a fund, we see that some investments are going in that unit trust, and that unit trust is borrowed. We must also, as an auditor of the fund, we must also ask for the unit holder register of the unit trust where the super fund has invested, to find out who the other unit holders are, so that we can establish whether that fund has invested in a related trust or not. In this case, obviously we have a problem, because the super fund has invested in a unit trust where the super fund of the brother and the super fund of the business partner has also invested. But mind you, there should be no problem, because the unit trust has not borrowed. So it looks like as if it is a related trust, but it is an ungeared unit trust. So section 71 comes into a problem. It's only when the unit trust has borrowed. If the unit trust has not borrowed, it is an exemption of SIS regulation 1322C, which we will talk a bit later. So as far as these parties are concerned, we always treat them as a group. So Part 8 associates, so the super fund uh, controls this trust, because maybe we have 1/3 share, but the super fund controls this trust because the control comes with the relatives, who is an associate, and with the business partner, who is also an associate. So the unit trust becomes a related trust. Now, the control can come in different ways. So, if you have more than 50%, and you should look at Section 70E2 of the SIS Act, and they talk about, it depends on the relationship of each party, more than 50% of the capital or income of that trust. So the trustee must have the majority of the trustee, or you should be able to direct the trustee. If you control the trustee, if you have appointing powers, or if you can remove the trustee, then basically you control the trust. Now, it can be either acting alone or with a group. So it ends up with a group. So I'm just going back here, and we are looking out here. So if the business partner, let's say, owns 60% of that trust, and we stop that business, so that means the super fund under audit and the brother own only 40%, then you will be fine, because you no longer have a business partner who is controlling that trust. So that investment goes to a trust, is invested in a trust, which is an unrelated trust. So it's the control. The control comes holding and the one who controls the trustee of that trust. Right, so just giving you an example. So we'll talk about some variations also. And this is something which you see very common. There is a unit trust where there could be a company or individuals. They are Doctor 1, 2, and 3. They are all trustees of that trust, and they have a medical center. And they have borrowed some money from the bank as well. And the 3 super funds of Doctor 1, 2, and 3 have invested in the unit trust. So everything looks okay, because we don't know whether they are in business together, whether Doctor 1 is related to Doctor 2. So let's look at the variation. Now, if this property is a residential property, and if it is leased to any one of these properties, then again, we have a problem. But if it is a medical center, and if they are partners of each other, if Doctor 1, 2, and 3, they are operating from this medical center, then obviously they are sharing the cost. Maybe there is a receptionist, maybe there's a one photocopier which they all pay for, electricity bills and things like that. So all of a sudden there is a relationship. What happens then is that Dr. 1 is related to Dr. 2, Part 8 associates, and Dr. 3 because they have a business together. Now, if you look at Part B here, Dr. 1 has an investment property with wife of Dr. 2. So let's say they don't have, they've just invested in this medical center and they don't operate from here. But Dr. 1 and wife of Dr. 2, all of a sudden, they own a property. So all of a sudden, these two parties become related to each other, Superfund 1 and Superfund 2. And if they are related to each other because they own a property outside of the fund, then we have to see if together they control the unit trust or not. And the way they can control it is because all three of them are trustees of the fund. So if 2 out of 3 trustees, they have a majority, they basically can do whatever they want. So then we will have a problem. So if you look at Part C, if Dr. 2 is an ex-wife of Dr. 1, so this is to explain further that ex-spouses are excluded from the definition. So we have to be very, very careful in looking at the unit register of the unit trust to make sure that there is no relationship, which is between the unit holders so that they don't become Part 8 associates. The problem we have here is there is a bank involved. Right, so going forward, let's take an example which is a little bit more common in the real world. Ben and Jerry are friends, and Ben contributes 50% and Jerry contributes 50% in a unit trust. They both are, let's say, individual trustees of the unit trust, and they have borrowed money and they have invested in a property and they are leasing that property out. Now, let's look at the variation. If Ben and Jerry own a property together outside of Superfund, we have a problem because then they become Part 8 associates. Now, if Ben marries Jerry's sister, then all of a sudden, uh, the spouses of the partner also are included in the definition of relatives. So again, we have a problem. Now, if if this is a residential property, and if it is leased, so the superfund is leasing to a related party, even then it becomes an in-house asset. But if Jenny is the ex-wife, we are fine because we don't have to worry about ex-spouses. So this is just to give you an example. Now, many a times super funds can make a mistake. They enter into these kind of transactions. So what are the remedial actions? So if we go over 5%, then the super fund must enter into a written plan in the following year. So this is year number 2. So on 30th of June 2023, this happened. So they must write a plan. And then in the plan, they have to show how they're going to reduce the balance below 5%. Now, you must remember that once it becomes a related trust, it is tainted forever. It cannot become an unrelated unit trust. So in the plan, it should be carefully written on how the investment will be reduced and what action must be taken in the following year. So 23-24, the plan is given and you are fine as an auditor. But if you're auditing 24, then what you need to do is you need to report this breach, because now what has happened is till 30th of June 2024, if it is not fixed by either one of the trustees of the super fund which you are auditing, then you must report that as a breach of Section 71 in your audit report. Now, moving forward, let's look at strategies on what we can do. So remember we said 5% of the market value of the super fund. So if there are other assets, we have to make sure that we must value the asset of the unit trust as well. So how would we know that the investment in the unit trust is 5%? So we maybe we invested, say it's a $2 million fund, maybe we invested $50,000 in that unit trust. But if the value of that $50,000 has gone up to more than $100,000, let's say it becomes after 4 or 5 years, it becomes 101,000. So all of a sudden, that 5%, which was $50,000, is no longer $50,000. It's become 101,000. And for a $2 million fund, then the investment is actually the valuation of that investment. The valuation of that 5% is actually a bit more. So it's no longer below 5%, it has become above 5%. So this is something which you must do as an auditor. If you're faced with a unit trust, then you should try and obtain the valuation of the units. And the valuation of the units will depend on the underlying asset of the unit trust. And only then you can check compare it with the total market value of all the assets of the self-managed super fund. There's another way. If you contribute more money into the super fund, then what will happen is the 95% will become bigger. And if that becomes bigger, then the investment in a related trust obviously becomes smaller. So, but this could be your written plan that you would be contributing and you must contribute. Now, we have to stop reducing the value of the fund, the 95%. And as you know, pensions will reduce the value. So you can consider stopping a pension in the super fund, which is invested in a related trust more than 5%. Now, we talked about SIS Regulation 1322C and the exemption to the in-house asset rule. There are basically two exemptions. That is, if you invest in a widely held unit trust, a widely held unit trust under Section 71H is where there are 20 entities, and between them, they own fixed entitlements of 75% or more. So that means you're talking about Westpac Trust or a syndicate, a large enough syndicate, where the super fund is invested and there are more than 20 people, and those 20 people actually own 75%. So it's more than 5%. Your assets could be more than 5%, but there are other lots of people in there and they have borrowed money and it becomes a widely held trust. And the other one is the 1322C trust. And the major reason that exemption is allowed is because that related trust has not borrowed any money. And we looked through the conditions of 32C trust. So it can own an asset, but the lease of that asset, like if it's a residential property, then you have a problem. But if it's a business real property, then the lease can be to a related party. And the trustee of the unit trust must not have any outstanding borrowing. So that is the key. Point number two, that related trust should not borrow. And we'll see it with an example as well. And there are other conditions as well. And I've seen quite a few funds that where the super fund invests and that related trust invests in another entity, or it does a business, and then those assets are charged. So that's where we get into trouble. So just going forward, let's have a look at the example of a unit trust where the super fund is invested. Obviously, the investment is more than 5% to the value of the self-managed super fund total assets, and the related party have also invested. And they together have bought a property. What is important out here is to note that the unit trust has not borrowed any money, and there is a property, and then there is a tenant. Now, the related parties, they could have borrowed, but on other assets. As far as there is no charge over the asset of the unit trust, you're fine. Now, the super fund will invest, and members can draw against their own home. So if they have their own home, and then they can buy property, they can invest in that unit trust, and the unit trust will purchase the property, and the lease of this property can be with related parties if this property is a business use property. Now, what is not allowed is that the same structure, it's a 1322C trust, that it is the unit trust has lent money to someone, or it has bought some shares or something, and it has invested in other unit trust, or there is a lease to a related party of a residential property, or if there is a charge over the unit trust assets or on that property which is owned by the unit trust. So as an example, so we have a 1322C trust, and it had some spare money, and it opened a USA bank fixed deposit. So that's a problem. So you can only have a bank account in Australia. You cannot have a foreign bank account, or you cannot have shares. So that's also not allowed, or you cannot have managed funds. So that's also a problem. So you should look at these taxation rulings, and then that will give you a little bit more information on what is allowed by unit trust and what are not. And if there is a lease to, if it's a residential property, if there is a lease to a family member or to a company or to a trust, I'm talking about a residential property in this case. Now, when you look at this structure, you will see that, it's similar to buying property tenants in common. So this is a structure. It's absolutely identical. Instead of, I'm just going back one more, that instead of the unit trust buying the property, what we have here is a structure which is tenants in common. Related parties and the super fund, they invest together. As long as there is no loan, you're fine. The loan is at your level, not at the property level. This is fine as well. And what will happen in this case, when this property is rented out, there's a certain percentage which is owned by the super fund. It'll be paid to the super fund, and a certain percentage of the income will be paid to related parties. Now, remember, if this is a residential property, then we cannot transfer the portion which is owned by related parties to the super fund. But if we put a unit trust in the middle, then section 66(2) will allow the super fund to acquire some of the units from a related party, as long as there is no borrowing. So this is the difference basically between tenants in common or having a 1322C trust. Now, you can transfer the units. So I'm just going back here. So you can transfer, if you put a unit trust, you can, over a period of time, you can transfer the units which are held by the related party to the super fund. And the super fund will be able to acquire more units, because over a period of time, they will get some contributions in, and some of the rental income can accumulate. So you will be able to transfer the asset to the super fund. Some of the units which are owned, some of the portions which is owned by the related party to the super fund. So that's permitted. So, but it must be done at market value. But it's better to have a property with a trust, because section 66(2)A allows the units to be transferred. But if this was a residential property, then the super fund cannot acquire a residential property from a unit trust. But if it's a commercial property, then we can acquire percentages over a period of time if required. But when you put a unit trust in the middle, it just becomes a little bit easier for the super fund to acquire from related parties. Now, this situation can be compared to LRBA as well, because many super funds get into a situation where they have to borrow money because they don't have enough money. They can ask the relatives, the self-managed super fund relatives, to contribute. into an LRBA, and the situations are, when the super fund is buying a house and land package, or they want to buy an old property and they want to improve that property with LRBA, all of those things are not allowed. Development is not allowed. So, or maybe they want to buy multiple properties, which is also not allowed under LRBA. Then a 1322C trust would work out a bit better. But there should be a provision that there's enough money with the trustees so that they can contribute into the fund, contribute into the trust so that they can lend to the trust. So this is something which you need to look at. Each and every situation will tell you whether you need a 1322C trust or you need a limited recourse borrowing arrangement in a trust. Now, this is can happen. Now, I'll just explain this a little bit slowly. So this is a related party. Let's call it members of the fund, and they go to a bank and then they borrow money. Now, the bank uses their own, principal place of residence or other investment properties, but not the asset of the unit trust. So what happens next is that instead of investing in a unit, in an ungeared unit trust, it can be done like that. But what the related party do is they actually lend the money to the super fund in a bare trust, and they lend for actually units in a unit trust. So what happens is that if you just simply lend it to the super fund and the super fund buys the property, the super fund cannot improve on that property. And there could be multiple of properties, or there could be house and land packages. So to circumvent that situation, to carve out that situation, what the related party do is they lend money to the super fund, and the super fund under a bare trust buying units, not the property, they're buying units in the unit trust. So the super fund can also invest in the ungeared unit trust, but then it is borrowing money to buy units in the unit trust. So the money actually flows through, and then the ungeared unit trust can do a house and land package. Now, house and land package cannot be done if you're going to use this asset as security. It can only be done if you have other assets outside of self-managed super fund. Now, another type of property development could be is, let's say, three friends get together. This is gearing at maximum. So all members of the super fund have property. So they all borrow from a bare trust from the members. So all the money gets collected here, and they don't control this geared unit trust. So there is no control, so it becomes an unrelated trust. So all super funds invest less than 50%, and the trustee is also independent. And then more money is borrowed by that unit trust, and then we get into property development and things like that. So these kind of transactions are quite a few. So Akif, I'm done. Uh, that's all I had to say.
Thank you so much,
I don't
Manoj.
know. I don't know if there are any questions or thereabouts. So I've just given an insight into, what can go wrong when a super fund invests in a related trust which has borrowed money.
Yep, Manoj, thank you so much for that insightful presentation. Your expertise and detail honestly have given us a clear understanding of managing related trust. And yep, we do have some questions. Shall I address those to you?
Yes, please. Yes.
Okay, so the first one is what is closed held unit trust? Is it meant related party unit trust?
Oh, yeah, they say closely held. Yeah, closely held is where I'll just go through it. Yeah, where there are two friends, and I think I had an example of Ben and Jerry here. So just going back. So this is a closely held unit trust where the public is not invited to invest in this unit trust. So something which is closely held, you're not offering it to other people. It's not a syndicate. So something like that will be called as a closely held unit trust. Now it's allowed to borrow. So there's no reason why this unit trust cannot borrow, because nobody controls this unit trust. In fact, I own a restaurant with a friend of mine, and the friend of mine the other day called me and said, there's another property, let's buy it outside of Superfund. And I said, no, because we have his Superfund and my Superfund in a GA unit trust, and that's actually a restaurant, not a residential property. We could lease it to ourselves if I knew how to cook. But that's what is a closed unit trust.
Thank you so much, Manoj. There is another question. Imagine
Yep.
an SMSF under audit have invested in a
Yeah.
unit trust where no single unit holder, including the SMSF, holds more than 50% interest and none of the trustees are related parties. What are the specific compliance criteria the SMSF must meet to ensure this investment is considered non-controlled and does not breach SMSF regulations?
Well, this is very simple. I think we had an example here. Let me go for it. I think where we had 3 people invested in a unit trust here. Yeah. So let me just look for that one. Hold on, please. That was a very interesting one where there were 3 people and the 33% invested. I think it was the doctor's example. So let's have a look at this one. So there are 3 of them, they own the unit trust. So let's say they are 33% each or thereabouts, and the bank has come in as well. So as long as we are not related to each other, Part 8 associates, so we are not relatives of each other, we are not in partnership with each other. So if you look at the example number 1A here, if the medical center is leased to their business, so all of a sudden, all 3 of them become uh, related to each other through Part 8 association. And that Part 8 association is because we are in business together, so that that becomes a problem. So this situation has no problems if we are not in business together, if we are not related to each other, and we don't own assets outside of this structure together. And I can understand that once you look at the unit register, when you see that there are 3 people who own it, and when you look at the tax returns of the unit trust, you will see that there is a loan there, right? Yeah. So you need to then establish whether Dr. 2 is related in any way with Dr. 1, and if that is the fund which is under audit, you need to make long inquiries whether any one of the members is a relative or not. Now, sometimes, because you're auditing Dr. 1, you won't have access to who the members are of SMSF 2 and SMSF 3. So sometimes you need to prepare a declaration, and that declaration should be signed by the trustees of the fund which is under audit, so that you can put your criteria very clear to the trustees of the fund. Because at some point of time, you need to stop investigating on whether it is a related trust or not. So you get a declaration signed, and once you have a declaration signed, I think that will cover you up. That's what I would think.
Thank you so much,
Yeah, are
Manoj.
there?
Yep,
Yeah,
there are 2 more questions. One is,
yeah.
when SMSF hold unlisted trust, how to audit it, how to know it is public trust or widely trust or close held trust or related unit trust.
Oh, that's very easy. If there is an investment in that trust, you have to ask for the unit register, and the trustees must provide it to you. If they can't provide it to you, then obviously it is, you should have financials of that trust. And if it is a closely held trust, you are auditing that trust. So although you may be appointed as, the auditor for Superfund 1, But if it's a closely held trust, that is only two parties, then you should be looking at market valuation of the asset, because the market valuation will determine, what the value of that asset is. Even if it is less than or more than 5%, that doesn't matter much. But what matters is you need to find out from the unit holder register of who the other members are and make sure that none of them are related parties of the fund. So it's the documents, I would say, the audit evidence which the trustees will provide to you. And then you need to make your own, as an auditor, inquiries of whether it's a public trust or not. Look, usually they give you income as well with phone numbers and all that. So third party audit evidence is always very valuable and should be regarded very, very highly. So you'll find out, I mean, it'll be a way. But once the other thing you could do is you could also ask for the trust deed of this unit trust. So that will give you more, clues on whether it's a closely held trust, because it'll have names of the trustees, and then you have to investigate further whether those trustees are related uh, to the trustees and members of the self-managed super fund which you're auditing. Yeah.
Thank you so
Are
much,
there
Manoj.
any?
Yep. One last question.
Yeah.
Can a 50-50 unit trust considered as a trust not controlled by anyone?
Oh, yes, this is fine. Like I said, I have a situation myself where I have a
Thank you so much, Manoj, and thank you for all of your questions. And that brings us to the end of our webinar today. Manoj, can you hear me? I think we lost your voice. Hi, Manoj, can you hear me?